It is the end of an era at Meta as longtime COO Sheryl Sandberg wraps up a 14-year tenure at the company today. Shares are down 60% this year, cutting nearly $250 billion from its market cap. But can things turn around under new leadership? Julia Borson's got more on this. Julia.
Well, Melissa, you're right. Sheryl Sandberg's departure does mark the end of an era. Take a look at this video that Meta gave us from Tuesday. This was her last day in the office at the company's Menlo Park headquarters. They call this a clap out. And her departure comes at a time when Meta faces its biggest challenges yet. And the stock has lost a quarter of its value just since Sandberg announced her departure on June 1st. The stock's now trading at its lowest level since early 2019, and Facebook is Meta is one of the worst performers in the S&P 500 this year, having lost about 2/3 of its value since peaking last September. Now, even before the economic downturn, Meta was facing serious challenges, including difficulty targeting and measuring ads in the wake of Apple's operating system changes, declining user and advertising growth rates in the face of growing competition from TikTok. Plus, there's antitrust and regulatory risks. And now, as the company works to pivot to focus on the metaverse and making money in the metaverse, it's also facing an overall contraction in ad spending, plus foreign exchange headwinds. Analyst Youssef Squali lowering his price target on the stock and warning, quote, top-line headwinds are likely to persist through the second half of 2022. But with the stock's drop, analysts are still largely bullish. 70% of analysts have a buyer overweight rating on the stock. Melissa?
Julia, thank you. Julia Borson. Its forward PE is just under 14. Julie Beal, do you like this one?
No, this one's not for me. I think the regulatory risks are a little bit understated. I think that's frankly going to be a larger and larger problem for them. And then just in the core advertising business, CPMs, they've just been struggling. And I think going into a recession, do I really want a ton of exposure to ad budgets, especially when there is a much more innovative player in TikTok where it's completely overtaken Facebook in terms of time spent, engagement. It's just much higher and much stronger. And I don't think really Facebook has what it takes to compete. They can copy. I mean, development for Facebook has moved from Snapchat to TikTok, but I think I'm pretty concerned about this one long term.
Value trade or value trap, Jeff?
It's sort of hard for me to say this just because of the way I feel about the broad market, but part of me feels like there's at least some opportunity here. To your point, 13 times earnings, still very profitable, high free cash flow, and it still is an important tool for businesses relative to advertising. So I'm feeling like this is a stock that maybe you can step into here, not look at it for 3 years and do pretty well. But if you are being tactical, I tend to agree with what Julie's saying. If you look at the chart, it's testing support from 2018, 2020. So if it breaks below that, there could be more downside. And, just generally speaking, with all the uncertainty in the market right now, the metaverse is creating, some doubt about the strategic direction of the business. And then if there is that pressure on the core advertising business, you could see earnings come down. So this is a stock that I think you can buy lower. But again, realizing you're never going to tick the bottom, I think there is some long-term value here at these prices.
Not just the direction, but the spend and the size of the spend to get the company into the metaverse. Once upon a time when this company was Teflon and you can throw a Cambridge Analytica at it or whatever you want at it and it still bounced back. The argument was that it was the only place to go, particularly for small and medium-sized businesses. I would think it still has that sort of destination status. Even if there's a broad pullback, it still would stand out compared to peers, Tim.
Yeah, although that was before the Apple operating dynamics and some of the things that have made their ability to really price, their service. I look at the CPM declines that we have in year over year, down 20%. We just got some of these numbers. And if you look at a 4-point decline just from July to August, off of comps that I thought would have been pretty good. So I think they're caught in as much cyclicality as any company. I know we have a lot of other problems for these companies. We talk about them all the time. I kind of think you priced in a lot of bad stuff. Again, I'll go back to my dollar argument. After a 28% of the move in the dollar in 15 months, they've got a 6% FX headwind at Facebook that also I think is a big deal that I think gets easier over the next 12 months. So easier comps. We priced in a ton of cyclicality. These media companies, and that's what this is, price this in before almost any other part of the economy.